US dollar hegemony, the architecture of global monetary power. The global economy doesn't operate as a neutral marketplace of equal currencies. Instead, it functions with a structured hierarchy in which one currency occupies a dominant position. The United States dollar has evolved into the central unit of account, medium of exchange, and the store of value for the global system. This phenomenon is known as dollar hegemony. It represents more than simple currency preference. It reflects deep structural dependencies in trade, finance, energy markets, debt issuance, and geopolitical alliances. Understanding dollar hegemony means understanding how financial systems become instruments of influence, how economic rules shape political outcomes, and how monetary dominance can sustain power without direct military engagement. What is dollar hegemony? Dollar hegemony refers to the structural dominance the dollar of the US dollar in international economic transactions. Countries use the dollar to settle trade payments, price commodities, store reserves, and issue international debt. When central banks hold foreign exchange reserves, a significant portion is denominated in dollars. When corporations borrow in global capital markets, the liabilities are often denominated in dollars. When commodities such as oil are traded, the pricing convention is typically expressed in dollars. This creates a reinforcing cycle in which global demand for dollars persists even when the United States isn't directly involved in the transaction. The dollar becomes the implicit language of economic coordination. Historical origins. Bretton Woods system. The institutional founder of dollar dominance emerged from the Bretton Woods Agreement in 1944. After the Second World War, major economies established a system in which currencies were pegged to the US dollar. While the dollar itself was convertible into gold at a fixed rate, this arrangement positioned the United States at the center of global finance because other economies relied on the dollar as an anchor for exchange rate stability. The system formalized trust in the dollar and embedded it within international economic architecture. Even after the gold convertibility ended in 1971, the structural reliance on the dollar continued because global trade and finance had already adapted to its central role. Role of oil and commodities. One of the most significant reinforcements of dollar dominance emerged through commodity markets, particularly oil. Energy trade is critical because all economies require energy inputs to sustain production. When oil producing countries price exports in dollars, importing countries must hold dollar reserves to conduct transactions. This creates structural demand for the currency regardless of domestic economic conditions in the United States. The linkage between energy trade and the dollar strengthens the currency's global role and connects financial power with geopolitical strategy. Commodity pricing conventions therefore extend monetary influence into physical resource flows. Reserve currency status. Central banks accumulate foreign exchange reserves to protect their economies from currency instability and financial shocks. A large share of these reserves is held in dollars because of the currency liquidity, reliability, and widespread acceptance. During financial crises, access to dollar reserve allow countries to stabilize exchange rates, support imports, and maintain investor confidence. The reserve currency function gives the dollar a structural advantage because the global financial system depends on its availability during periods of uncertainty. Trust in liquidity reinforces trust in the currency itself. Network effects and the financial institution. Financial systems exhibit strong network effects once institutions adopt a common standard, switching becomes costly and inefficient. Global banking infrastructure, payment settlement systems, and financial contracts are structured around the dollar. Because international banks clear transactions in dollars, they maintain relationship with US financial institutions. This interconnected system creates path dependence, meaning the established currency maintains dominance because alternative systems lack equivalent scale and trust. Financial infrastructure therefore acts as a reinforcing mechanism for monetary hierarchy. Advantages for the United States. Dollar dominance provides structural advantage to the United States economy because global investors seek dollar denominated assets. The US government can borrow at relatively lower interest rates. Persistent global demand for US Treasury securities enable the United States to finance fiscal deficits more easily than other countries. Trade deficits become more sustainable because foreign economies recycle dollar earnings back into US financial markets. This creates a feedback loop in which global confidence supports domestic economic flexibility. Geopolitical influence. Control over financial system allows economic influence to function as a geopolitical instrument. Countries that rely on dollar-based settlement systems remain sensitive to financial restrictions. Sanctions can limit access to international banking channels, restrict trade settlement, or constrain capital flows. These mechanisms operate without physical confrontation yet exert substantial pressure on targeted economies. Monetary influence therefore becomes part of broader strategic competition among states. Challenges to dollar dominance. Despite its dominant position, the dollar faces structural challenges from emerging economic powers. China has expanded the international use of the yuan through trade agreements and financial partnerships. The euro functions as a major regional currency within Europe. Technological developments such as the central bank digital currencies introduce alternative settlement mechanisms that could gradually reduce reliance on traditional systems. These developments suggest the possibility of a more multipolar monetary structure in which influence becomes more distributed. Future of global currency power. Monetary systems change slowly because they depend on institutional trust, legal frameworks, and financial infrastructure. While alternatives to the dollar are developing, replacing an established global currency requires coordination across governments, banks, and markets. Technological innovation may accelerate change, but structural inertia remains strong. The future of currency dominance will likely reflect shifts in economic production, geopolitical alliances, and technological capabilities. Monetary hierarchy, therefore, remains closely linked to broader patterns of global efficient power making.